Welcome to Mortgage Talk 101 here on Super Talk 1270. Time to look behind the numbers. Buying, selling, refinancing. Mortgage Talk 101 addresses real issues in real estate. Now, live from the Super Talk 1270 studios, here's Mortgage Talk 101 host Joe Sheehan.
Your body built for radio, saddling up the stainless steel microphone of the Mortgage Network. Here with my co-host.
Hey, Dave Flohr, Mr. Housing, right here.
There we go. And last week, just a absolutely fantabulous show.
Oh, we had Brian Ritter. I mean, what more can you have?
Wind him up, let him go.
Yeah, absolutely.
What were the highlights from Brian's interview?
No, the highlights, I just talking about what's happening in Bismarck, around, you got the new high school being built up north and what's going to happen around that area, with the Dans going up there and, Gordman's and Dick's Sporting Goods and all that going up, and how that's all, affecting the housing in the city. It's, how do builders keep up with all this activity that's going on and people wanting to move here? That's kind of was where the discussion was at.
Well, you know what the best part about it is that, and I look forward to this every time, is that is that more complaining about traffic.
Yeah. We talked a little bit about that too. Yeah,
I love it.
Going from the south side of town, Brian, his personal story, I think, was thinking about, he lives on the south side, go to Ruby Tuesdays for dinner. Nah, it's too far to drive. Take too long.
Yeah, it'll take too long. Yeah,
15 minutes.
Well, it's because I can't speed unabated.
Yeah. Well, you have
to down 9th.
You can go up 9th, or you can't go up Washington or whatever.
Right.
I guess you could go around the interstate, but
because when there's no traffic there, the speed limit's like 55. Or something.
Yeah, right.
And I could get to Ruby Tuesdays in 5 minutes.
It does make a difference.
Get my salad bar. It takes me 10 minutes. See, if it takes me longer to load to get there than it does to load my salad bar plate,
not going.
Then I'm not going.
Okay. All right. Okay. That's your determining factor. Okay. Well, you and I have a benefit. We live in the middle of town.
I do. I go everywhere.
We both do. And we can go either direction.
And it takes just as long either way.
Yeah. So we're perfect.
And now in my neighborhood, there's the Broadway Bar and Grill. And so we've got local establishments. A walk downtown.
Do you have your own table there at the Broadway?
The pond and right. Yeah.
The Sheehan
they yell
table?
Norm. They yell at Norm when I walk in the
Joe!
door. Yeah, exactly.
Okay, all right.
But Lucky Ducks and the pond aren't too far away. And
you can walk if you want to.
By the way, if you haven't been to the pond, I really suggest the duck drummies.
I've heard the duck. I have not been there, but I've heard the duck stuff is just.
It really
super.
is. I think it's great.
Yeah.
But I am your body built for radio.
Yeah. Well, I bet you're looking good though.
So anyway, mortgage rate update, and then we'll get to the.
Oh, let's talk about mortgages. How about
that?
How
about that?
Okay. Mortgage Talk 101.
Right. It's just the other stuff is what we really want to talk about. It's just we have to have an excuse to have a show.
Yeah, exactly. Yeah, we had 5 minutes of mortgage talk and the rest of it. Maybe we should just. Jim, what are we allowed to do?
Do you know they've got a new tap at the Walrus? Anyway, let's see. Well, the big news affecting mortgage rates. This comes off of Graphs and Laughs with Elliot Eisenberg.
Okay.
Swiss and French economic growth flat in Q2. Germany's economy shrinking. Italy in its third recession since 2008. And its economy no bigger than it was in 2000. And now reduced Europe-wide growth from tit for tat, Russian EU sanctions. Europe is in trouble. And to that, Brazil being in recession and China's rate of growth weakening. Suddenly, the slowing, improving U.S. economy looks good.
Yeah. Isn't that something? So what does that mean for interest rates? They're probably just going to muddle through, maybe even go lower.
And that is the mortgage market guide. Let's be clear, according to Bill Bodner, we have been talking about this forever. Europe is a mess, and there are no easy fixes. They have huge economic issues in and around the Eurozone, and they don't have a fiscal union in place to make the structural reforms necessary to help them grow their way out of trouble. Devaluing the euro by lowering rates and QE, quantitative easing in Europe, that is, will help with exports, but it doesn't fix the lack of competitiveness between the member countries within the Eurozone. Economic growth would fix a lot of their ills, but nobody is seeing it.
Yeah. Well,
go ahead.
Oh, I'd say Elliot also on Tuesday, his blog, he talked about inflation rating. Inflation really is nothing to worry about. But inflation in Europe is at 0.3 year over year and falling. So they really are a mess. I mean, they're leaning towards deflation.
That right, and the D word is worse than the I word.
Because they are paying for banks to deposit their money in their central bank. They're in negative interest rate territory right now.
And
so they are charging their banks to park their money there.
Just like a good catechism. So what does this mean?
Yeah, what does this mean?
The U.S. dollar continues to reign supreme in response to a weakening euro. This should help bonds at least hold at current levels and maybe even push higher. And when bonds push higher, folks, that means interest rates go lower. Mm-hmm. At least hold at current levels and maybe even push higher. The stronger greenback will also help suppress oil prices, thereby giving us more relief at the pump. There's the jobs report coming out tomorrow. So the big thing is, what do you do in the short and the near term? A quick look at the bond chart or at interest rates shows prices near the top of trading and at multi-year highs. Heading into an uncertain report and uncertain market reaction, any clients closing within the next few weeks should consider locking and capturing these rates while they are here. However, if your clients have time and the stomach for some near-term volatility, it would be interesting to see if bonds can test and break above the nearby ceiling of resistance, because should it do so, we will see the lowest rate in years, kicking off a potential fourth quarter refi boom. Our lips to God's ears. And of course, not that homeowners want to necessarily be in a refi boom, but certainly lenders. One of the big stories in the mortgage industry, folks, if you don't know it, is that with refinances having kind of gone away,
right,
with interest rates going all the way up to the low fours, it has taken a serious toll on the P&L statements of banks, because the mortgage activity they were counting on for profit has really reduced with just being purchased, home purchase business out there.
There was a lot of people, and this is not just North Dakota we're talking, this is nationwide, that really were just focused solely on refinancing, the last 3 years up until maybe this winter. They're hurting if that was their focus. They're hurting right now. So
our Freddie Mac, with the 2
right,
minutes left,
so
our Freddie Mac mortgage market survey, average rates on the 30-year fixed-rate mortgage, 4.1 with a half-point discount, 15-year at 3.24 with a half-point discount, and that's the same, slightly down from on the 15. It actually is down on the 15-year. The 15-year got better from 3.25 to 3.24 with the discount point improving, but the 30-year fixed-rate mortgage holding steady.
And it was steady last week too.
And and now what it sounds like is, if what Bill is saying is, if you're closing your mortgage in the next 30 to 60 days, take the bird in hand, because what you could see is, could rates get better? Sure, but you might have to ride out seeing them get worse first before they get better, because we're going to get in some volatility as the market heats up with all this uncertainty from Europe and recessions all over the world, and nobody knowing quite sure how that's going to impact us. But long term, could you see 3% interest rates again?
You could, because of Europe is a mess, as Bill says, and it doesn't look like they're going to get much better. And everybody is just saying, safe haven, it's the United States.
And when did he say that? When did he speak at your convention? When did he speak at the North Dakota Housing Conference again?
2.5 years ago.
2.5 years ago, Bill Bodner stood up there talking about how Europe is he said Japan is a bug looking for a windshield, and Europe is a mess.
Yeah.
And those are and that was enough to, what he thought, guarantee low rates. And he's still predicting 2020.
2020 before it gets crazy. Yeah.
So okay, we'll go into the break, and we'll come back with more headlines from the mortgage industry on housing reform, what you do. We're looking for questions. If you've got questions, go ahead and give us a call here at the studio, 663-1270.
With $1 in my head.
Currently, it's 61.
When the weather turns bad, turn to us. Bismarck Mandan's Emergency Weather Information Station, Super Talk 1270.
There was a time in this fair land when the railroad did not
Canadian
run.
Railroad? Yeah, by Gordon
And
Lightfoot.
the wild majestic
Well, back with Mortgage Talk 101.
Okay, I got something that's not mortgage.
Okay, let's
Okay, we might as well start with that.
let's do our non-mortgage
Stuff.
segment of the mortgage
Okay.
segment.
All right. Well, all right. Okay. This comes from Elliot Eisenberg again. This is from last Friday. Did you know last Thursday actually was National Bow Tie Day. Elliot wears bow ties.
Elliot wears bow tie.
He wears bow ties.
Yeah.
Did you know that?
I did not know that.
My wife and I were talking about this. We figured that there's every day is a national something day, I think.
Every day is something. Yes.
It is something. We should actually look that up and find out what every day is. And when we do their show, we could actually talk about what it is that
What
day.
the national day is.
So
for the
last week, I missed this last week. When we had Brian on, Brian and I could have talked about this. But last week, Thursday, National Bow Tie Day. Bow ties were probably first worn by Croatian mercenaries and brought to Western Europe by French soldiers in roughly the early 1600s. Did not know that. How many dollars do you think are spent on purchasing neckwear in the United States in a year?
Oh my gosh, it's got to be. Well, it's got to be less than it used to be, but more.
Okay.
Because now you got designer stuff.
It's above $100 million. What do you think? Jim, what do you two fire in on this?
273 million.
Okay.
I'll say 400 million.
Okay. 850 million.
Whoa!
7% of that total, 59.5 million, is bow ties. And in the Southeast, this is interesting. This must be all the Southern lawyers, right? Bow ties are 14% of all neckwear purchases, so double what they are nationally. And Elliot hopes that none of them are the dastardly clip-ons.
Hey, don't trust your
The
soul and go back with
dastardly
Southern lawyer.
clip-ons.
What about the Southern lawyer?
You know what? As soon as you are clip-on, you're out of the club.
Yeah. Oh, I think so. Yeah. So Elliot's a real guy. All right.
A lot of money just to look like Buddy Holly.
Yeah.
You know,
Yeah.
he had
Really.
that bow
Yeah.
tie going.
Yeah.
So
Okay.
let's stick with the non-mortgage related thing.
Okay. You got something else?
I proud dad. My daughter last night featured on the news.
Oh, was she?
She was interviewed. Got to meet Kat Perkins. Kat Perkins
Oh,
was
okay.
speaking at Roosevelt and Highland Acres. And,
Okay.
And so Sydney, and it's on. If you go to Joe Sheehan, you can see it on my Facebook page. It's also on the Cornerstone Bank page.
Okay.
And you can see the interview. And if that's any indication, of her future skill, our jobs here could be in danger because.
Well, they're in danger every day, aren't they?
Probably.
The good thing it's not a job necessarily.
Necessarily.
But
it won't have a massive financial
but
impact.
she's good.
Yeah, no, she nailed it.
Cool.
Summarized Kat's message and
Yeah.
and personally related it to herself and didn't or ah too much.
Okay.
So
Well,
no,
that's
she did
good.
it great. She's 11 years old.
Yeah.
And she did a fantastic job. So that's out there if anybody wants to
Cool.
see my daughter and her professional.
So this was on like K-Fire
speaking career or agent career.
K-Fire or KX did something with
It was KFYR.
Yeah, okay,
Was
cool.
and apparently she's all over town right now and performing.
Oh,
and singing.
Cat is.
Yeah. She's
Yeah.
all over the place right now.
Yeah.
running
Well, she got
around.
rained out at Medora.
Oh, did she?
So they had to reschedule. I think it's probably rescheduled this weekend.
I did not know that.
Yeah.
I did not know that.
Yeah.
One last thing from Elliot, with the Fed's preferred inflation gauge currently running at 1.6% year over year, well below the Fed's 2% long run target.
Mm-hmm.
Real personal income growth flat, real household spending declining by 0.1% in July, and inflation in Europe at a staggeringly low 0.3 year over year. Don't waste your energy getting worked up about inflation.
Yes. So
Moreover, just to coincide with the earlier message
So
that we were
what
giving,
does that mean? Rates
Rates-
are not going to get probably much higher in the
It
near
just
term.
means Bill Bodner is about to look like the biggest genius of all time.
Well, we knew that
if
about
he,
Bill.
If his prediction comes true on that long of a
Of
forecast.
2020, yeah.
So
I'm leaning more towards him. As you
It
hear
was
things
one of the-
going on in the world, you lean more towards really what Bill has said, that rates are going to be low for that long.
folks, I've repeated that forecast in front of a few mortgage company CEOs, and I'm not talking about little mortgage companies like we have right here in North Dakota. I'm talking about $3 billion, $5 billion, $10 billion mortgage companies, where their job is as CEOs is to actually make money on making decisions about how their hedge departments respond to what interest rates can do in the future. And every time I tell them what Bill says, they get a twisted look on their face as if it's the craziest thing they've ever heard. And mind you, that they hire professional financial analysts to tell them what's going to happen about rate futures. And so when they hear that, and yet here we are since 2008, one guy.
See, they're not
7 years later. I mean, he is still on target with the exact prediction.
See, that's where those guys their perspective is not wide enough. They're listening to they're a little bit insular, if that's the right word, and they need to listen to stuff outside of their little world there of financial analysts and listen to people that deal with mortgages every day and whatnot, like a guy like Bill.
But I get it. If I had to make long-term and short-term decisions today for the bottom line, and my job depended on it, listening to a guy who said rates are going to be low till 2020.
Well, yeah,
I would have a hard time.
stomach.
I would have a hard time. I mean, if we walk in and ask Pat to run NDHFA that way today, what's he going to tell you?
Yeah, that's right.
He's going to say, I can't base what we're going to do on one guy's opinion on 2020, but he is going to look like he will need to write the book.
Yeah, Bill, maybe that's what he's planning on doing is writing a book.
I said it. That's what the name of the book should be. I said it.
Neener.
I said it. I meant it when I said it. Okay, so
all right.
Headlines today.
So
you brought in some great headlines.
What do we want to talk about?
Let's sell Fannie and Freddie.
Okay, that's a good one. Don't kill them.
Now, don't kill them. Let's sell them. Who do we sell them to? Warren Buffett.
Warren Buffett wouldn't be able to afford them. Yes. Maybe Warren is.
He's not the richest man in the world, but he's the kind of guy who would buy them.
They were talking about $200 billion, weren't they? Well, him and Bill Gates together, they're buddies. He could
finance
partner up. Yeah, they could partner up.
There'd be a private capital firm out there that would.
What this came from, this idea comes from James Glassman, writing in the Washington Times. He actually works with a guy we've had on our show here, Ed Pinto, at the American Enterprise Institute. But I think Glassman's been involved in finance stuff for years. He's a journalist, but he's also, I think he worked in one of the administrations of Bush's administration or something. So, smart guy, I guess. He's saying don't kill Fannie and Freddie. Don't get rid of them. Sell them. Look how much money you could get for them today. They're generating a profit.
Oh, they're generating a huge profit.
And you have all these people that probably would buy into them.
And
they've paid all their money back to the Treasury plus extra, and they're worth something today. So sell them and make a profit and reduce the deficit or do something with it.
Everybody who has been yelling about shutting them down. Okay, I'm telling you right now, every financial advisor out there is ticked they don't have access to sell this stock.
Yeah.
Together, they will earn about $20 billion in profits this year. That's more than General Electric.
General Electric. More than General Electric. Think about that.
And the two mortgage giants announced they'll pay another $5.6 billion in all their second quarter profits. This is the second quarter profits to the U.S. Treasury. That brings the total bailout repayments to Fannie to $130 billion or $14 billion more than it received. So let's listen to that. Okay, hold on, folks. Listen to this. Yeah. How are you doing on the investment made to save Fannie and Freddie as a taxpayer? How are you doing? Okay. That brings the total bailout repayments from Fannie and Freddie to $130 billion or $14 billion more than it received in bailout money.
Okay, that's just Fannie.
Oh yeah, and Freddie has paid the Treasury 88. They paid $17 billion more. So we're at $31 billion. Yep. To the plus side on a return on our investment.
And how good a return is that in 6 years? That's a 17% return on the investment of 6 years ago.
Who's in?
I probably everybody.
You know
in this
what?
room.
Here's what we do. Here's what we need to do. We need to start a website saying let's buy Fannie for one of those websites like who is it? The Daily Show guy. He started one of those.
Okay. Stewart.
Yeah, John Stewart.
Colbert.
Okay. We need to start one of those buy Fannie Freddie websites.
Yeah, there you go.
And then run them like the Green Bay Packers.
Yeah.
Everybody gets a season ticket.
You get a little certificate.
We're all owners.
Yeah, we should. We're taxpayers. We should get their.
And we should run them like the Green Bay Packers.
Yeah. No, to be fair, I don't think a lot of what Fannie and Freddie and profits, some of it was accounting stuff, and some of it was like there was some settlement fees on lawsuits and stuff. So it's not expected that they're going to make this kind of money going forward, but there's still enough there that these two companies are worth billions of dollars, hundreds of billions of dollars, if you would sell them. And I think Mr. Glassman here goes on to talk. He figured it based on his analysis, you could sell them for around $200 and some billion, and you could take that money, throw it at the annual deficit, or put it into. They want to create a housing trust fund out of Fannie and Freddie profits, so just take that money and put it in a trust fund for housing, right?
And the other thing is the FHFA came forward and said too, okay, we're never shutting these things down. They actually changed their policy regarding these guys, folks. We're not getting rid of Fannie and Freddie. This is this
sounds kind of like something that should be thought about.
This is one of those things where it's the boyfriend you hated that she keeps bringing around to the dinner table, and you think that you think eventually she's gonna dump him. Oh, it looks like she's gonna dump him. You'll never see him on the holidays again.
Yeah.
Oh, guess what? They just announced they're getting engaged. Fannie and Freddie's gonna be around for a while, folks, showing up for Christmas, Thanksgiving, and Easter. After the break, we'll be back with more mortgage news and Mortgage Talk 101.
Currently, it's 61.
Get the app called Radio Pup for your iPhone and take us everywhere you go. Bismarck and Mandan's own Super Talk 1270.
Picking up the pieces of my sweet shattered dream.
That's where we need to be, the Carefree Highway.
Oh, we're so mellow today.
Because on the Carefree Highway, do we care about the next mortgage crisis?
No.
Not on the Carefree Highway.
Not on the Carefree. No way. No way.
We don't care. But anyway.
But somebody cares about the next mortgage crisis coming this winter.
Jeff Cox does.
Okay. What does he say?
He wrote, mortgage crisis is coming this winter. Actually, he's actually quoting
Dick Bove,
yep,
banking analyst. Dick
Bove.
Yep.
Basically, the lack of buyers is going to dry up the funds to keep the 30-year mortgage going.
And so he's directly talking about the Federal Reserve cutting back on their bond purchases, right?
Yep.
That's what he's saying.
The money's going to run out.
Yep.
And so there's going to be no way. Well, and well, we'll get into let's talk about the article a little bit. Bove envisions a scenario in which long-term financing, like the ubiquitous, what a great word, ubiquitous 30-year mortgage that has come.
What's the short word for ubiquitous? Like the normal, the standard, common.
Yeah.
Yeah. Okay. Common.
The ubiquitous 30-year mortgage that has come with fixed interest rates is endangered as mortgage buyers dry up.
Okay.
So less money available to fund housing, and that this will be considerably more onerous than what was available under the 30-year fixed rate loans. Bove said in a report, this means higher monthly payments and lower housing prices. It means a crisis in the mortgage markets and the economy.
Okay.
This isn't completely crazy.
No, it's not.
I mean, not that anything, not that it's crazy at all, but it's certainly not completely crazy.
One thing I would say about this is that he's saying that basically because the Federal Reserve is stopping their bond purchase program, the QE, they're winding it down. They're down to what, $10 billion now, right? That they're buying a month. So next month it's supposed to end.
We'll be done.
We'll be done with it. They're not going to buy anymore.
Then rates can get better finally.
Yeah, because that's what's happened the last two times it ended, right? Yeah.
Right.
Okay, so well, what were we just talking about right now? Are buyers going to dry up if you have this going on in Europe? Europe's a mess. Japan's the bug. We're looking for a windshield. So the investors are all coming to the United States for safe havens. Okay, that means more money flowing into our country. They're looking for investments, probably bond purchases, mortgage-backed securities, etc. So we're going to have all this inflow of money, maybe, that will really pick up what the Federal Reserve has been doing. The Federal Reserve is only buying $10 billion right now. Mm-hmm. So we're down to that. So that's not a lot to pick up in the great scheme of things. And the other thing is that would not the Federal Reserve, if they stop in October here, and that's their last month that they're purchasing bonds and whatnot, and things start to go south again, you think that they're going to stand by and not do anything about it, and they'll say, well, we're going to ramp up QE4. Are we on QE4?
Yeah.
It would be QE4.
I don't know. I think that there's a law that they have to stop when they exceed the number of Rocky movies.
That's 6, right?
Right. So I think they have a limit of 6 times that they can do QE.
But isn't there a new Rocky movie in the process?
Well, and
I think there is.
That is a conspiracy that the Fed
started.
Has got Sly Stallone working on to expand the number of QEs they can do, which tells you how many QEs are going to be necessary to get us through this process.
Yeah, 6, a minimum 6. So we got 2 more left, 3 more left.
Yeah, exactly.
All right. Okay. So that's all part of this. I mean, he is correct at some point. I mean, maybe this could cause a problem, but factors are coming into play here that really might make this. That's not going to happen.
Here's where this is a part of what I think is a common mistake. Well, and who listen to how presumptuous I sound here. I'm the little guy on this little radio show in North Dakota saying that people are making a mistake with a Fed-centric view of the world, a constant Fed-centric view of the world.
Uh-huh.
This idea that the Fed stops something, boom. The Fed starts something, boom.
Yeah.
The Fed makes a phone call, boom. And I think there is a phenomenon here that he's accurately describing that could impact mortgage markets. Higher rates to attract investors into the pool of funds will increase mortgage payments and will lower house prices. If that's dramatic.
Mm-hmm.
So if we go from 4.25% rates today to 6.5% rates in a month, 2 months.
Yeah.
You're going to see house prices drop.
Yeah.
But if you see a 2 or 3 year period of rates going from 4s to the 7s, now will house prices drop? They could, but not drastically, and they'll stabilize over time to normal levels of cost of living inflation and things like that.
Yeah, you're going to have some people that would get on the market. Oh, okay, it's not selling. I got to lower it $10,000. And then it sells.
Right.
It'd be much more of a gradual thing. And people today, I might think, well, my house is worth $300,000, and then I try and sell it 2 years from now, and it's still that's all it's worth.
Right.
It hasn't appreciated.
Right.
Darn.
And that's why it's so important as people are being advised into home ownership. This is why it's important to always look at home ownership as a long-term commitment. It's a long-term investment. It's not a short-term investment.
Yeah.
You don't buy a house with the idea that you're going to turn it and make money on it in a short period of time.
Yeah.
Because there is this inherent risk of what the financial infrastructure around the financing on a house does to house prices. So even if you're a cash buyer, you got to pay attention to this because this affects what every house around you is going to do based on the affordability factor of homes in that neighborhood. And so I can agree with the premise. The idea that increasing interest rates due to a lack of artificial stimulation by the Fed could wind up, if rates wind up going up for whatever reason, you get, you're going to impact the affordability of houses. The only place for that to come to then keep selling houses is to lower the prices.
Yeah. Right.
But that could happen for a gazillion reasons.
Yeah.
I mean, not the Fed, but we kind of look at the Fed, and really the way the Fed stimulates the market is by putting money into banks and big borrowers' pockets. And then they stimulate the market by putting that money back into the market through improvements in infrastructure, by lending it out for short-term projects.
Yep.
And that's how things get done. And in fact, one of the most effective things that the Fed did by keeping interest rates low, more effective, I think, than buying bonds, was that by keeping interest rates low, investors, big investment houses, used the money, borrowed it from the Fed at 0% or 1%, bought mortgage bonds with it on loan to recover the yield. So let's say we were going to buy, what's the name of the biggest bond buyer in the world? how could I forget it right now?
Oh.
PIMCO.
Oh, PIMCO, yeah.
PIMCO, the largest bond buyer in the world.
Gross.
So
Yep.
let's say they're going to buy $50 billion in bonds today.
Mm-hmm.
They're going to buy $50 billion in bonds today, but because the Fed's lending out money so cheap, they're going to buy $100 billion in bonds today.
Yeah.
Because they're going to use $50 billion from the Fed because they're getting a 3% yield on the or 6% yield on the long term or the short term money from the Fed.
Right.
So they double their investment in the bond market, lowering rates, and it's called the carry trade, and it's one of the most effective things. It's a result that's a byproduct of the Fed's control over liquidity of money,
Right.
not what they're spending the money on.
Yeah. Yeah. That's what it is. So anyway, as this guy says, a mortgage crisis is coming. I kind of don't think so.
I don't think so, and not for this reason.
The markets are going to take care of themselves.
Is a mortgage crisis coming? It could be.
Yeah,
It could be, but it's based on the idea that we're having a population issue
yeah,
of bringing in people who can afford housing demand. It's because of wage stagnation,
yeah,
not being able to produce new buyers that can get into the market and afford the increases in house prices, which then could be, if you had a perfect storm where you had a couple of dynamics like that, along with the affordability factor get impacted by a significant increase in interest rates, could you have a housing crisis?
yeah, absolutely. Yeah,
But not because the Fed stopped buying bonds.
I don't think so. Yeah, there's just too many.
Well, I'm glad
factors
we fixed
that are in
Bovey.
there.
Well, I mean, just because he's some expert who's got 20 years experience in
But
this,
you know,
and a PhD in BS.
But but the guy who writes something like this, he's starting a conversation about it.
Stimulated thought.
He's stimulating thought, which
Gave
is
us a radio
not
show.
bad, which is not bad. And the other thing in this article, he talks about, eliminating Fannie and Freddie. He said that's maybe not a good idea either because they want to replace it with a system that's going to require all this capital buy-in from the big investors, as you stated. And he said that's just ain't going to happen.
Okay, and when you require the capital buy-in from those investors, what is the unintentional byproduct of that?
Yeah,
You're taking away capital they would have lent to businesses,
right. Yeah,
to stimulate the economy.
So they're going to throw that in there. What are they going to do? They're going to want a higher return on that investment to make up for what they got to put aside in capital. So that's going to drive rates up. And he's saying that's not really a good plan. And I think he would probably agree with our last article we talked about with James Glassman that maybe just keep them alive, the GSEs, Fannie and Freddie. Keep them alive because really they can work if you keep the political meddling out of the way.
And Mel Watts is decided.
Yeah.
Done.
Yeah.
I'm not talking to you guys anymore. We're keeping them open.
Yeah, I think so. I think he really has. Yeah.
And I'm done playing games. We're past it. They've made enough money now that I can just say, go ahead, make my day. Try to make me shut them down.
Yeah, I think so.
So, okay, after the break, one more segment here on Mortgage Talk 101, and we'll be back after the break. Dave and Joe.
Currently, it's 61.
Get the traffic and weather information you need anytime on Super Talk 1270 and online at supertalk1270.com.
It's alright for some, not alright for me. When the one that I'm
Dave,
loving slips
I can see it in your eyes. You want to talk about housing and race.
The color of money.
So you got an article on housing and race.
Yes. This comes from the Housing Wire. Trey Garrison, he writes, actually very prolific writer in the Housing Wire, but he's talking about housing shouldn't look at any color but the color of money. And he's talking about lenders. Okay, and I think I agree with him. He's saying people with bad credit and bad habits should be squeezed out of buying a house. And what he's looking at here is, there's a lot of, and there has been for a long time with the Community Reinvestment Act and affordable housing goals that FHA's put on Fannie and Freddie and all that. Mm-hmm. It's pushed towards, you got to have more people have the opportunity to buy a home, et cetera, right? Mm-hmm. Okay.
It was a big driver in the subprime crisis.
Yeah, and a lot of people blame what happened in the late 2000s, the housing bubble and everything, on some of these governmental policies to try and drive people into home ownership, basically, is what they were. Okay.
Finding ways to get private investors to back products that you could serve those neighborhoods and areas with.
Yeah. Interest only, negative amortization, No doc loans, stated
No
income,
credit
all that
loans.
good stuff. So
No pulse loan. Well, no, you had to have
no
a pulse.
You had to have a pulse. You had to have a pulse. Yep. But he says today, even though there is an issue with minorities not getting as many home loans as whites or non-minorities. Okay. And he said, but and some people may think that people are being turned down because of the color of their skin, but in reality, that doesn't happen. And he gives some examples here, but Joe, two people walk in your office. One's a black, one's a white person. They both have a 750 FICO score. They got a 20% down for down payment. They both get a loan.
Yes.
Okay. Doesn't matter
Because we're paid on commission.
Okay.
So
all right.
two is better than one.
So a white person walks in. They've got a 500 credit score, and a black person walks in. They got a 500 credit score. They don't have any money for down payment. Do they get a loan?
No.
Okay. So it didn't matter what the color of their skin was, did it? Yeah. Okay. I didn't think so. And that's his bottom line. It totally depends upon your financial circumstances. Okay. Not the color of your skin. Now, what he goes on to say is that instead of focusing on making lenders worry about that they're financing enough home loans for minorities, really, he said, they should be left out of that equation. They should not have to think about whether they're financing enough mortgages for minorities. They should just be allowed to make loans and approve loans and originate them based on the financial circumstances of the borrower in front of them. Okay, and I think most people would agree with that. Ability
to repay credit, and that's it.
And now what Trey goes on to say here is that if there are not maybe as many minorities making applications for loans, and that's probably true. And if you look at the data and you say, well, these minorities, maybe they got turned down for a loan because they had that 500 credit score with no down payment. No, the bank turned them down. So that all shows up in the data that's being reported through the HMDA, to the feds. And what he's saying is really there's other reasons for those people not getting loans, and it's not the lender's fault. If we want to address that problem, it has to come from another direction.
And we have a classic example of that. And these are always dangerous topics to talk about, but we have a live example of that in the Bismarck area with minorities, particularly with the tribes.
Yeah.
And what happens is, and I don't know if this is still true, but it had been true in the past. Medical bills.
Mm-hmm.
Medical bills, there are apparently special programs, and feel free to call in and educate us more detail on this, but this is how it's explained to me when I deal with borrowers from the reservation. But supposedly there are medical programs in the tribes that will pay for bills that wind up happening as a result of medical treatment.
Okay.
And so there's programs that will pay these bills for tribal members.
Okay.
And but the process for those bills to get paid is lengthier than the need to collect the debt.
Yeah.
And so what that means, folks, is that it may take a year or two or three for that money to get to the provider who provided the health service.
Yeah.
And in the meantime, though, the health provider's got a debt collection policy that says it has to be paid in 60, 90, whatever days.
Yeah.
And so the consequence is when that bill's not paid, it goes to collection. Mm-hmm. And it starts impacting a person's credit.
Right.
And it starts impacting, then it becomes a judgment.
Yep.
And then all this becomes a major credit impact event in terms of your ability to qualify for a home.
Yeah. So then even if that bill eventually gets paid and it was paid off last year, that's still going to show up on that person's credit report as a collection and a judgment against them.
And it's going to impact the credit score.
Yep.
And it's also going to impact the credit risk parts in the analysis of the decision engine for the mortgage. Most people don't know this, but whether or not you qualify for a mortgage is first decided by a decision engine, an electronic tool that calculates the risk of whether or not
Putting
you'll.
the data in.
Yep. It's just a you hit a button and it says, will this person pay back a mortgage or not? Yes or no.
So,
And so this all gets put in, and if you have open collections, past collections, this all gets calculated into the risk, automatically making any one of these borrowers who has those derogatory or past derogatory debts more risky than somebody who doesn't. Okay, so now if you're a white person from Bismarck and you're not a tribal member, there isn't any special program that's going to eventually pay.
That's on me, probably.
That's going to eventually pay that bill for you.
Yeah.
Good, bad, and different. That's just the way it is.
Yep.
So there's no unintentional impact to those people's credit unless they purposely don't pay those bills.
Right.
Now you have you have a tribal member from the reservation who doesn't do anything wrong at all, except for depend on
The system.
the promised benefit.
Yeah.
Winds up with a negative impact to their credit situation that gets
Gotcha.
analyzed in the credit risk score, and all of a sudden, as a lender, I wind up in a situation where I'm approving less Native Americans or less tribal members for home loans. But am I doing that?
No.
No,
No.
I'm not doing anything.
The other federal government, arm of the federal government,
Right,
that's
and
doing
so are
it.
more
Yeah.
white people getting right because the consequence is not just a future home loan someday to
Yeah.
a white person. The consequence is immediate collection action,
Right.
where their checks are going to get garnished and stuff like that if they don't pay that bill.
Yeah.
So they pay it and they have better credit, but it's not because they're doing anything more right. It's because of how their situation winds up
Right.
determining behavior
Yeah.
that unintentionally
Yeah.
has a benefit in a different goal down the road.
So going right to Trey's point, there's other issues that need to be addressed from a different angle to really maybe help the situation on the lending side.
and some
it
of
should
them
not
are
be the
some of them
lender's
are
job.
institutional,
Yeah.
like for example reservation
Right.
benefits program systems.
Yeah.
Some of them are also institutional forms of just poverty and race.
Right. Yeah.
And
But it should not be focused on lenders are the bad guys making this happen, and they, to look at them to solve the issue.
This is
wrong.
trying to help somebody perform better in a NASCAR. Let's take NASCAR. This
Okay.
is like trying to help somebody perform better in a NASCAR race by trying to somehow fix what their car should have done, but doing it at the end of the race.
Yeah.
So their engine isn't very good.
Yeah.
So let's somehow push them across faster or something.
Yeah.
at
No,
the end.
let's roll this into
Versus
another
fixing
article we
the
looked
engine.
at. Yeah. Let's
And
roll
making
this
sure-
into another article we had about there's FICO, which does the Fair Isaac credit reporting. They have a new credit score model out there called FICO 9 that is going to take into account medical bills and lessen the impact on somebody's credit score if they had collections or judgments due to medical bills that are now paid. They would lessen the impact on the credit score. And right now, the reluctance of the Fannie Mae, Freddie Mac, and FHA to use that model is there because they would then have to pay to update their underwriting systems to accommodate that new model, and they don't think it's worth it to do that yet. It sounds like that would really be a good thing because I think in a lot of cases, you and I would agree that medical stuff, that's stuff that happens to you. You don't have a lot of control over it, if any, in a lot of circumstances. And if you eventually have paid those bills off, should they really be affecting your score negatively if you've taken care of them?
Even
you
old,
had a short time.
Even old credit. Recently had a borrower who what they did is they had bad credit 7 years ago.
Yeah.
They paid it all off, took care of it all 7 years ago.
Yeah.
But they established no new credit because they were kind of like,
Since
learned
then.
our lesson. We're not going to do
Yeah.
that
Yeah,
anymore.
right.
Well, now they have no new credit.
Yeah.
Still denied.
Yeah. So, all right. Okay, next week, we're not going to be here.
No.
Realtor convention in town.
Yep. Guest host Don Smith from Red Door Homes will be coming in. He'll have an appraiser on the line, and he will also be talking about building new construction.
So it's
next
gonna be
week
a-
on Mortgage Talk 101.
It's going to be a Joel and Dave free day next Thursday.
You guys get a vacation, finally. Oh. All right. Have a great week. It's always partly sunny here in Mortgageville.
You know that ghost is me, and I